Yes.
Anyway, welcome everybody to our Central Texas section monthly meeting. This is mostly affinity groups. So we have a whole slew of affinity groups hosting or in support of our meeting here. It's the Central Texas section live members, Central Texas Consultants Network, and then all the Denver section, Fort Worth, Houston, and Lone Star section, which is San Antonio. All the different live member groups are in support of this. We the Central Texas section live members group, we have various speakers on topics throughout the year, and we welcome speakers. People like yourself could consider to become a speaker in the future. If you are interested, please contact either Kai or myself or one of the other officers. The potential topics could be in technology like 5G, 6G, IoT, AI, smart city, or non-technical things like finance, investments like what we will be talking about tonight. And also, since we have a lot of live members here, hobby, travel, and education. And many of our members, of course, are engineers, so you could be talking about your engineering career and your contribution, or what your thoughts are. Health and aging also, and also history of engineering and science. And sometimes we try to put together tours also to either businesses or museums or things of interest to our group. So this is the officers list for the live members group. Bill Martinez, the chairman. Tom Grimm, the vice chair. Bill Martino is also the treasurer. Clyde Springen is the secretary. Kai is the program manager. John Purvis, webmaster. Dennis Ferguson is communication. We are always looking for new volunteers to join our team. So if you're interested, please contact one of us. The Central Texas Consultants Network promotes the development of members' careers through professional and social networking, including publicizing members' skills and sharing potential professional opportunities. Our webpage has a members list where you could have a small, short blurb, a one-liner or a very, very short paragraph describing your skills, so other people can look you up. And of course, we support the IEEE Central Texas section. So this is the membership, or this is the slew of officers in the Consultants Network. Luis Basto, that's me. I'm the chair. Jody Everett is both the vice chair and treasurer. Bill Martino, the secretary. Kai is also our program manager. And Sergio Lieberman is the member at large. We do have an opening for webmaster for this group. So if anyone's interested, if you know anyone interested, please welcome them or send them in. So I'm gonna turn it.
So the topic for tonight is a 2023 investment outlook. It's already been in our announcement. We have inflation and high interest rate that kind of carry over from last year to this year. And also starting beginning of the year, where a lot of tech company and service company like banking, they announced layoff, and a lot of talk about recession, and the Fed trying to increase the interest rate. And so the question is, how going to handle investment strategy this year? So that's why we invited Mr. Bill Greiner to talk about this topic. He look at the market, economy, and also the trend. and he'll bring more information and matrix and news headline to support his talk. So I think that the balance is he has about more than 30 years of experience in the investment field. He started from North Trust Company, which is a banker for Motorola, our ex company, then UMB, and now it's Marina. So probably you already read this. So Bill, the floor is yours, or Grant.
Okay, great. Well, thank you.
Stop reading.
Can you hear me all right?
Yeah.
Okay,
Yes.
good. Get my slides up there. That'd be great. I'm only looking at a Zoom picture right now. I don't know if that's what we want to look at or not, but I'll go ahead and while the slides are getting up there, I'll go ahead and there we go. I'll go ahead and start off the conversation and thank everybody for your ear here. What's going on with the economy and the capital markets right now, in the economy, and what does this mean as far as where we are within the business cycle, and all that affects what's going on within the stock market and the bond markets and really all capital markets. We're suggesting before we kind of getting the punchline out really quickly here, we believe the weight of the evidence. We're looking at a lot of data, but also not just in backward looking, but forward looking data. Models basically that have given us some kind of forewarning of a change within the business cycle. That the weight of the evidence basically suggests an income statement, what I've classified an income statement oriented recession, appears likely sometime this year going into 2024. I'm looking for it to start sometime this year. Don't know when, and I'll describe why I don't know when, and the indicators that suggest that indeed we probably are coming into some kind of an economic slowdown. And the question then comes into, are we going to actually see a recession? So I'll start off the conversation with a description of the business cycle. The typical business cycle has 4 stages. Starts off with a recovery as the economy is bottoming and coming out of a previous recession until GDP growth gets back up to where GDP growth was prior to the start of the previous recession. That's considered the recovery stage of the economic cycle. And during that recovery stage, things are turning around. Business investment starts to push to the upside very rapidly. And unemployment stays fairly high during that period of time because businesses tend to spend money on capital projects prior to actually hiring people during the typical business cycle. The next stage of the business cycle is called the expansion phase, is when the economy is plowing new ground as far as output is new levels, new high levels. And this tends to be the longest portion of the cycle, where the economy is growing very nicely, unemployment is moving to the downside. The stock market tends to do very well during that period of time. Corporate profits are tending to rise fairly nicely during that period, and interest rates are staying fairly low. The next stage is called the boom phase, and that's normally speaking where something is starting to go wrong in the economy. We're starting to develop an excess of some kind. Either there's excessive debt being created in the economy, or there's too much inflation, or something's not working out well. There's an imbalance basically in the economy that's being created during that boom phase. And we're suggesting that that's basically the phase we're in right now, is the boom phase. Normally speaking, the boom phase is classified as a period when unemployment is very low. Most of the business news you have is looking backwards. In the last 3 months, things have been pretty good. Retail sales are okay. Housing starts are starting to move to the downside, but nonetheless, everything seems to be okay. Then we fall into recession. And normally speaking, that happens right after the boom phase basically runs out of steam. And it's normally engineered and generated by the Federal Reserve. Typically speaking, if you look back over the last 8 business cycles, almost all of them, except for the pandemic issue that we all went through back in 2020, the previous 7 business cycles we went through from the 1970s all the way through to 2 years ago were preceded by a move on the upside in interest rates engineered by the Fed in trying to contract money supply because they saw an imbalance in the economy that needed to be fixed. And one way you fix something that's going wrong in the economy is you slow the economy down so the economy can heal. Well, normally speaking, that works fine up to a certain point, but the Fed then tends to overdo things on the downside. They tend to increase interest rates too high, or they tend to contract money supply too much. or whatever it might be. It flips the economy into a recession, and then we actually see negative GDP growth. Unemployment tends to push to the upside pretty hard during those periods of time. Corporate profits tend to fall. The stock market goes into a swoon prior to that period and into the recession. We think we're kind of at that stage right now. We've experienced a boom stage in the economy coming out of the pandemic. Unemployment now is at a multi-decade low. Corporate profits are high. Corporate profit margins are high. And now we're just starting to see cracks around the edges of that issue because there is a problem, and that problem is inflation. And the Fed, with their monetary policies and their mandates as far as why they're in existence in the first place, is to maintain a stable pricing environment. And when we have inflation basically pushing up by 7 or 8% a year, that in nobody's stretch is not stable. So the question then comes down to how long is the boom phase going to last, and when do we go into recession? And we're suggesting recession is probably going to start sometime this year or early 2024. There's three models we use, and there's a lot of data here on this page. Let's go to the next slide. Gwen, if you can move us to the next slide. There we go. There's three models we utilize when we're looking at forward data. Most of the data you hear about the economy, be it retail sales, be it housing sales, whatever it might be, is backward looking. It's what happened yesterday or last month or 2 or 3 or whatever it is, but it's backward looking data. So there's got to be some data out there that tends to be forward looking. Where are things going to go going forward? How have those indicators behaved during previous business cycles? And the first thing we look at is what's called the yield curve shape, the shape of the yield curve. And that's the relationship of long-term interest rates to short-term interest rates. Now on this page, you'll see going back to 1962, the relationship of short-term to long-term interest rates. The blue line is the 10-year U.S. Treasury yield less the federal funds rate, and that's the Fed funds rate that the Fed directly controls, and they've been raising up now for the last year. And normally speaking, Fed funds are a lot lower than the 10-year Treasury. There's a spread there with the 10-year Treasury normally higher than the Fed funds rate, and that just makes sense because longer-term rates are going to be a lot higher than short-term interest rates because as an investor, you're committing your capital for a longer period of time. You tend to demand higher returns if you're willing to do that versus overnight lending. But when that relationship flips is when the yield curve enters what's called an inversion stage, and that's an oddity. And you can see on this slide, going back to the early 1970s, prior to almost every recession we've seen going back in time, that relationship of short-term interest rates is higher than long-term interest rates before the recession starts. And there's a fundamental reason. It's not by guess and by golly that, this just happens. It happens for a fundamental reason. And the economy going into recession. That is that the cost of capital with most lenders is short-term sensitive, meaning they pay depositors for 3-month CDs or 6-month CDs or whatever they are, and they lend the money out for 5 years to 10 years. So normally speaking, the bankers and lenders live on that spread of low interest rates to high interest rates. When that relationship flips, what do? They stop lending money, or there's certainly the growth rate of lending tends to slow. And that tends to move the economy to the downside. And as far as growth is concerned, and if it goes too far, then we go into recessionary environments. So this chart, the red line is the 10-year minus the 2-year Treasury, and the blue line is the 10-year minus the federal funds rate. So they both are in negative position now, and they've been negative now for almost a year. So a lot of people say, well, normally speaking, if they've been negative for a year, why haven't we seen a recession yet? Well, typically speaking, that relationship is negative for up to 2 years prior to the start of a recession. So it's not unusual. But every time you look back in time, the only time this relationship flipped into a negative territory that we didn't see a recession was during the mid-1990s. But prior to that and after that, every time this relationship flipped into a negative standpoint, within a 2-year period of time, we experienced a recession. Timing-wise, it's really tough to figure out with this, but is the recession going to occur next quarter, a year from now, 6 months from now? Nobody really knows. But if you look back in time, part of the issue is how aggressive is the Fed going to be? Let's go back to the previous slide. I'm still working on that. Over the last 9 cycles, the time between the trough and the trough and interest rates, as far as the Federal Reserve is concerned, and a recession has been 2.5 years, as I mentioned before. The average rate increase, as far as the Fed rate increase and increase in rents, Fed funds were at 0 this time last year, by the way, in their first move on the upside was 0.25%, which occurred in March. And after that, they got more aggressive. And now we're close to a 4.5% short-term interest rate environment. The rate increase prior to recession starting, going back in time, from the trough of the interest rates to the start of the recession is averaged 473 basis points, 4.73%. And right now we're at 4.5. So this suggests, going back in time, the Fed's been as aggressive over the last 12 months as they normally have been for a 2-year environment prior to the start of recessions. So this tells me that a recession probably is forthcoming, let's say in the next 6 months, maybe 9 months, sometime this year, rather than in 2024. It may occur then, but my bet right now is it's probably going to start sometime this year. Let's go to the next slide now. There's 2 other models we look at that have historically given us a pretty good read that, yeah, the risk of recession is probably higher now than normal. One on the right-hand side of the page is the 6-month rate of change of the leading economic indicator index. The LEI is something to look at, and that's fine. But the real telltale sign with the LEI screaming that, yeah, a recession probably is forthcoming is looking at the LEI now compared to where it was 6 months ago. It's basically as a momentum measure of economic momentum. And if that number, if that is coming down and it's down 3% or more, going back in time, going back, this little chart here just goes back to the year 2000, but going back even further than that, the 1950s, every time that relationship has shifted down 3% within 2 years, the economy has been in recession. So this model, this indicator is suggesting it's forward-looking, is suggesting the probability of us being in recession is fairly high sometime later this year. On the left-hand side of this page is our last indicator that tends to give us a forward-looking view as where things are heading, and that's the PMI indices. It's the Purchasing Managers Indices. This is basically a poll of purchasing managers, both on the manufacturing side of the economy and on the services side of the economy, and asking them, how are things going in your business? And if the answer is less than, if that index falls below a reading of 50, then basically it indicates that either the manufacturing or the services side of the economy is in contraction. As you can see, the blue line now is below 50. And normally speaking, before recessions in the past, when the blue line, when the manufacturing side of the economy is in contraction, then normally speaking, within a year or so, we're probably going to be in recession. So all 3 measures are telling us that, yes, indeed, the probability of us being in recession is much higher than normal. Now, come back to a baseline. As engineers, you understand baseline concepts probably better than I do. But a baseline of a recession, typically speaking, going back since the end of World War II, the question you'd ask is, how often has the U.S. been in recession? And the answer is 12% of the time. So statistically speaking, you have a 12% probability in a year of experiencing a recession. It's a fairly low probability. So we're suggesting that if we're at 50% with these 3 models, we're suggesting to clients we have probably a 50% probability that this year we're going to be in some kind of recession of some sort. Let's go to the next slide, Gwen. Now, recessions occur, as I mentioned before, because of a major factor in the economy is out of balance. Too much of something or too little of something. I'll give you an example. The deep recession we saw in 2007 through 2009, that I classify as a balance sheet recession, which is typical, which is similar to the recession we saw during the Great Depression in the 1930s. In the 1930s, we had a series of recessions, about 3 different recessions all rolled together. And that was driven by balance sheet problems where there was too much debt in the system that needed to be washed out, and confidence basically went to 0. And this was very similar to the reasonably brief but still deep recession we saw back in 2007 through 2009. That recession lasted a year and a half. GDP contraction was 3 times the average recession. It was deep. And the reason is it was a balance sheet recession. We had way too much debt that was unserviceable on many segments, either the corporate side, the banking side, the consumer side, all 3 segments of the major segments of the economy, except for the government, were way over levered, and things needed to cool down, and people needed to write off debt, and that's a painful experience. This time around, the problem that we have is the imbalance that we have in our economy is inflation. And inflation is more easily handled, it's more quickly handled in a recessionary environment than a balance sheet problem. And because to handle inflation, basically what you have to do is slow the marginal rate of demand downwards, and that tends to soften pricing pressure. And that's what we saw basically in the early 1980s when we went through that double dip recession, early 1980s, and that's what we think that's kind of recession we think we'll probably start to see sometime later this year. So let's go to the next slide. Conditions are similar now to where they were in the early 1990, 30 years ago. 30 years ago, we had a very brief recession that lasted about 8 months. And this recession we'll probably have forthcoming is probably going to be very similar, at least in my view, as far as why we're coming into this recession, what kind of activity it's going to take to make it go away, make that excess go away. In 1990, we had an environment where consumer sentiment was poor. We had oil prices that had gone up over the previous year or two. Iran invaded Kuwait. Back in those days, creating a lot of political uncertainty. The Fed was active in trying to lower inflationary pressure, and real estate price was starting to contract. We started to see real estate prices pushing to the downside to a certain degree. This led to a recession lasting 8 months, and the stock market decline of about 21%. 2023, we have the same kind of conditions. We have a poor consumer sentiment. Oil prices over the last couple of years have gone up. Instead of Iran invading Kuwait, we now have Russia invading Ukraine. The Fed certainly has been active in trying to lower inflationary pressure, and we're starting to see a crack in housing values. Indeed, I live in the Phoenix, Arizona area. My wife's a realtor, and she's telling me that housing prices in Phoenix are probably down between 8 to 10% just over the last 12-month period of time. So we're starting, in certain markets, we're starting to see real estate values crack to the downside. So a similar environment we saw in the 1990s. Let's go to the next slide. So if the problem is inflation, we have various measures of inflation, all right? And there's the CPI, which is Consumer Price Index, which a lot of people really understand and know, and they follow in the news. It's the one that makes the big headlines. There's also the PCE, which is the Personal Consumption Expenditure Deflator. This is the one that the Fed pays a lot of attention to. And as you can see on that slide to the right, a little dotted black line on the slide is the Fed's 2% target. And the headline of that number now is 6.2 and the core number is 5.1, whereas the CPI is still above that kind of number. These two indices measure different things by different weights, and they actually measure different items within the pricing environment. The Fed tends to spend a lot more attention on the PCED than they do the CPI. When they say they're going to continue to contract money supply until we see a 2% handle on inflation, they're really talking about the PCED and not the CPI. I'm suggesting to clients that with this spread, you're probably talking about the CPI coming down to a 4, maybe 3.5% rate before the Fed say, "Uncle, we're going to stop we're going to stop raising interest rates and see how things go." So it's important to understand the differences with these indices, but know that the Fed is looking at the PCED rather than the CPI when they're talking about inflation. Let's go to the next slide, Glenn. There's been a spike. There was a spike in the money supply back in 2020 with the COVID problem. And since then, money supply growth rates have contracted very, very deeply. I'm a follower. My training in economics is as much monetarist as it is Keynesian. And what I mean by that is I think money matters. I think Federal Reserve policies matter. I think money supply matters. Because money basically within the system is what makes the system work. Without money, the system basically stops transacting. And the availability of money, the ability for banks and lenders to lend money is very, very important for economic growth to occur. When the actual supply of money is pushed to the downside, then lending standards tend to rise, and the free flow of money tends to start to soften. Now, going back at time, let me get the data here for you. M2, which is a broad measure of money supply, and this chart shows M2 growth rates. I think, and M2. M2 growth rates going back over the last number of recessions has contracted 9 months prior to the start of recession on average. As for actually gone negative, where money is being drawn out of the system. And the average contraction has been negative 2.6% prior to the start of recessions. Typically speaking, over a long period of time, M2 has grown by about 3.5% per year. All right, that coincides, it's not a coincidence, but it coincides with the average GDP growth rates in the economy. M2 growth rate is basically going along with M2 growth rate with GDP growth rates to basically fuel overall economic activity. Prior to recessions, again, the Fed gets active and they draw money out of the system, reducing money supply. And that sends the economy eventually about a 9 month lag into a recession. The first contraction that we had in money supply occurred this past May, and it hit a negative in about November. The contraction on a 3 months rolling basis annualized was negative 7%. It's the deepest contraction we've seen in M2 growth rates going back for, I think, 5 decades. So the Fed has been extremely active in drawing money out of the system. And in my mind, this is an indicator that, yes, indeed, we probably are going to see a recession, because whenever the Fed has done this kind of thing before, and even just a fraction of this activity, the economy within 9 months has fallen into recession. Okay, let's go to the next slide. There's 2 alternatives to the recession. We're calling for a 50% probability the economy is going to be a recession this year. There's 2 other possibilities. One is the stagflation that we've seen over the last year, where inflation is higher than normal and economic growth is still positive, but is lower than normal. That kind of environment could continue as we move forward. It's not our base case as far as economic outlook is concerned, but it is something to think about. If that happens, in my mind, that's the worst of all worlds, because what's going to happen if that occurs, if inflation stays high, let's say above 5%, in the 6-7% range, the Fed's going to continue to tighten and drive interest rates higher and higher. And eventually, when the recession does occur, it's probably going to be deeper than it really needs to be. Eventually, as the little bullet point here says, inflation doesn't meaningfully give way to stag in a stagflation continuing situation. Normally speaking, inflation does give way to stag, because, as I mentioned before, final demand tends to soften and prices tend to come to the downside. Under this situation, the Fed continues to tighten monetary policy, GDP growth slides but remains positive. Inflation runs 5 to 7. Eventually, recession is deeper than core forecast. The other possibility is, the Fed is actually successful in the economy, in guiding the economy into a soft landing, where inflation comes down, GDP growth rates soften, but they don't go into a negative territory. They don't fall below 0, and people maintain jobs. Unemployment doesn't push to the upside. Inflation comes down, interest rates come down, and it's kind of the Goldilocks scenario where everything works. All right. And that's sort of like the Fed trying to land a 747 jet aircraft on an aircraft carrier. It's very, very difficult to do, because the Fed's tools they have at their disposal tend to be like sledgehammers. They hit the economy very hard until they figure out the economy is slowed. And by that time, it may be too late. Over the last 8 cycles, the Fed has successfully landed the economy once out of 8 times. And so they've tried 8 times, they've done it once. So from a historical probability standpoint, the Fed has got a 12% probability that they'll be successful this time in the soft landing scenario. I'm skeptical that they'll be successful at that effort, but I'm hoping they do. If they do, then the stock market's going to soar on the upside and everybody's going to be very, very happy. That's not our base case. Let's go to the next slide. So what in numbers, what are you expecting with a recession forthcoming, but probably a light recession certainly as compared to the 07 through 09 experience? What kind of numbers are we expecting going forward? We think GDP growth will decline this year to about somewhere between 1% and 2%, but it's going to be kind of a valley followed by a recovery. as compared to 2021 GDP growth rate of about 1.7. Unemployment rate rises to 5%, we think, this year, from the low we're seeing right now in the mid threes. So we're not expecting unemployment to rise like it did in 07 through 09, but up to above 10%, like it did back then. We think it's probably going to increase to maybe 5. Now, President Bullard, who's the president of the St. Louis Fed, has publicly stated he believes if we hit 5% unemployment this year, that's when the Fed starts to reduce interest rates. When they don't just pause, they actually reverse the trend and they start reducing interest rates. I think that the probability of that happening by the end of this year is fairly high. So we're suggesting to our clients that the Fed is probably going to go neutral here for a while. If what happens to the economy happens, in our view, then more than likely the Fed is probably going to start reversing gears sometime late this year. Let's call it late this year, early 2024, and interest rates will start coming down. Inflation contracts significantly from the 6% kind of numbers we saw last year, reaching 3.5% to 4.5% by the end of this year. The Fed raises Fed funds rate to 5.25%, which they're just about there now anyhow, and pauses, followed by a first rate cut by the end of the year with a question mark. Long-term rates rise to 4%, followed by a decline by the end of the year. So we're constructive towards the economy this year. We just think we have some noise in front of us where GDP growth rates might get a little more challenged, where unemployment levels start to push to the upside slightly, but not out of hand. And by the end of the year, things will probably be back in a very positive mode. Let's go to the next slide. Within the stock market, Jeff Kaplinger, who's our chief investment strategist, has looked at the variables that I've thrown at him regarding the outlook as GDP growth rate, inflation numbers, unemployment numbers, and so on and so forth. And he's come up with the 4 following scenarios. Well, he thinks what the stock market is probably going to do this year. And his base case, with a probability of 60%, he believes the S&P will see a high this year of about 4,500. Right now, we're at 41 and change, right around 40, 50, something like that. So he believes we're looking at about a 10% move from today's valuation levels upwards by the end of this year. Now, it may do this. It may porpoise quite a bit and see some downward drift and upward spikes too. But in general, he's looking at this as a reasonably positive environment for the equity market. And I'll explain why, if you'd like me to, a little later. His other three scenarios is an optimistic case that if I'm wrong and the Fed basically engineers a soft landing, he thinks the stock market would probably rise to 48.75 by his data, which would mean a price return of greater than 20% from where we are today. A disappointing case is if we fall into recession and it's a little deeper than what we expect, then the high the stock market may go down to 3,500. That'd be down about 15% or so from today's valuation levels. Pessimistic case is we get into a deep recession, a very deep recession like we saw in 07 through 09. And he thinks the downside then would be about 3140. It's down about 20% plus from where we are today. So we kind of have the waterfront covered here. But his base case with a 60% probability is suggesting that the stock market's probably going to do okay. It's going to have a lot of volatility to it. There's going to be some anxious moments with some downside drift at times, but in general, we'll probably see some of an upward drift within the stock market from point to point with a lot of porpoising in between. Let's go to the next slide. One of the things that he's relying on, which I think is rather interesting, we think inflation probably has peaked for this cycle. And we think the peak was hit probably sometime late last year. And if you look at the bottom block of this data here on this page, you can see that going back since the 1950s, looking at previous periods when inflation was running hot, what had happened went from the peak inflation after inflation started coming down, what happened to the stock prices over the next 6-month, 12-month, 24-month period of time. And you can see the returns have all been positive now, except for the 08 through 09 experience. And that, once again, was that very, very deep recession. So his history is if inflation is actually coming to the downside, as it seems to be right now, history is on our side to suggest that over the following 6, 12, and 24-month period of time, the stock market should do okay. It's not going to be gangbusters, perhaps, over certain periods, but it should do reasonably well. Let's go to the next slide. And that should be, no, I don't want to look at this one. Let's go to the next slide. Where, if you're not looking at the S&P 500, where is one of our favorite camps right now as far as placing fresh capital in the stock market? One of the things we're showing our clients is from a valuation perspective and from a historical standpoint coming out of recessionary environments, one asset class that tends to do very well is U.S. small cap. So we're suggesting to clients that if you don't have money invested in U.S. small cap markets, that's an area that might make some sense, based again on history coming out of recessionary environments and also coming out of periods when inflation is starting to cool to the downside. And again, from a valuation perspective, small cap stocks historically tend to sell at premium valuations to large cap U.S. stocks. The reason has to do with growth rates. Small companies tend to be growing more rapidly than large cap companies. And right now, the PE ratios of the average small cap company is sitting just about on top of where large cap companies are. So based on historical standard, we're suggesting to our clients, look closely at the small cap area. And if we see periods of market weakness over the next few months, look at that as an opportunity to place small cap equities, in your portfolio. So in summary, where do we think things are at? Well, we believe the economy is kind of ending that boom phase of the cycle. And we're probably coming into a recessionary environment that's going to be light, it's going to be shallow, more than likely, in our view. And it will, by the end of this year, it will probably be through that short recession. We're still constructive on the markets because with the 20% or 23% move that we saw from peak to trough last year on the downside, was the market basically forecasting that, yes, indeed, we are probably facing some kind of economic slowdown going forward as the market tends to be forward-looking. And we think most of the damage to the market probably is behind us. And so we're looking for opportunities. We're not jumping in today, but we're looking for opportunities to place capital to work in the capital markets as the year unfolds. Gwen, back to you, or whomever, I'm sorry.
Thanks, Bill. Kai, I know, or Louis, there was some questions. I don't know if you want us to, do you want to go ahead and ask those of Bill or just open it up where anyone can ask? Yeah,
in the chat room, there's a number of questions. Maybe I see Mr. iPhone online. Want to pick, if you didn't get any answer, maybe it's time for me to ask again, or you can look at the chat room. You can find those questions. Or Mr.
iPhone is Beram.
Yeah, Beram, you can speak to Mr.
Can I start talking? Meaning,
yeah, sure.
Not disagreeing or agreeing. It's just I've got many questions listed. And I don't know why it comes on iPhone, but anyway, it says that. First question was, is inflation devaluation of our currency or not, USD? All right. I read recently in realmarkets.com that it's a currency devaluation of inflation is considered as the devaluation of our currency. That's it.
Over a longer period of time, the answer to that question, I believe, is over a longer period of time that is accurate.
Okay.
And one of the ways the government can repay debts is through devaluation of our currency, because the debts become less valuable with a cheaper currency than with an expensive currency.
Yeah, that makes sense. That makes economic sense. By the way, I didn't realize that Fed fund rate is at 4.5%. Nick Temeras, I read Wall Street Journal every day, and Nick Temeras and other boys at Wall Street Journal says it's 4.75.
It is 4.75. I'm sorry.
Oh,
that is correct. Right.
Right. How does the debt ceiling of the federal government affect our economy? And then I have a question about the Federal Reserve Bank also. Helping foreign governments. Okay. Yeah. Anyway, those two are just. All
right. The federal deficit and the debt level has the capacity of crowding out other borrowers. And the Fed, people basically view the Fed, the Treasury, U.S. Treasury, is that if they don't tax enough and they need to repay their debts, they can always start the printing presses, which is what they did back in 2018, 2019. I'm sorry, 2021, excuse me.
Right.
And so if the Fed borrowing power becomes too large, not the Fed, but the Treasury's borrowing power becomes too large, then they have the capacity of squeezing out other borrowers within the marketplace because interest rates are rising. And to a certain degree, some would say that's happening now. I'm not sure if that really is the case, but that's one of the problems with the deficit. There's a lot of problems with the deficit, I believe, over a long period of time.
Sure.
The other question had to do with the Fed. I'm sorry.
Yeah, it's a Federal Reserve is helping foreign governments as well.
Helping what?
Foreign governments, meaning giving them money also. Judy Shelton in Wall Street Journal had written one article, and I don't know, 6 months ago or something, and I read about it. And so I was curious, do you know that Federal Reserve Bank is helping, not this war in Ukraine, but just helping money-wise, transferring money and circulating money and all that stuff in the foreign governments?
Yeah, I don't know. I don't know if they're giving money to them, but certainly the flow of capital, with the U.S. dollar being the major reserve currency for the world, that kind of activity, the flow of capital from U.S. to other foreign central banks does occur.
Okay. Yeah, I was curious about that. Yes. Okay, yeah. I understood now.
Yeah.
All right. It was not Iran, but Iraq invaded Kuwait. I mean,
I'm sorry.
Yeah.
You are right. That's right.
And how does urbanization affect this economy, today's economy? Because you mentioned in the 1950s the economies was mostly rural, but these days we are in high tech and all that stuff. So economy is larger. Today's economy is larger, so the momentum of that. I'm talking like an engineer, so I hope you understand that.
No, I understand.
Okay, so the momentum of today's economy is much more greater than 1950s economy, which was primarily an agrarian economy. Do you buy that or not? Meaning quantity of economy, the dollar value in that GDP of the economy, if you want to compare with that.
Yeah.
I'm talking about momentum.
Okay. I think the character of construction of the economy certainly, of course, has changed. We've gone from, you're exactly right, we've gone from an agrarian-based society, primarily in the early part of the 1900s, to an industrial-based economy, which happened from 1940s basically until sometime.
What was the GDP in 1950s?
Well,
I mean, the value of the GDP today is $22 trillion.
Right.
So the momentum, I'm using the word moment, mass into volume. So the volume is impacting the economy devastatingly. And even in the 80s, Paul Volcker hiked the interest rate to 18%.
Right.
I mean, do you buy that? I mean, do you realize that?
I think the overall economic growth rates, the actual rate of change itself has actually contracted. It's still positive, but it's contracted on a systemic basis going back over the last 5 decades. And
50 years. Okay. Yes.
Yeah. So from 1960 or 70 to when GDP growth, since the end of World War II, U.S. economy has grown by an average of 3 on a real basis after inflation by 3.2% per year. Okay. All right. Over the last 15 years, that growth rate has been less than 2. So while it seems like our economy is kind of rocking and rolling at times, the economy's growth rate now is much lower than it has been historically going back over a long period of time. Mm-hmm. Part of that has to do with population growth. Part of it has to do with worker productivity growth rates, and both of which are lower now than was the case from 1960 till I want to say probably 2005, something like that. From 2005 to where we are today, both of those measures, worker productivity growth rates and demographic population change has slowed rather dramatically.
The bureaucrats have become lazier. Is that what you're saying?
I'm sorry?
The bureaucrats. I mean, the economy is primarily United States economy is the capitalist or corporatist economy. And
Right.
then the government hinders, in my opinion, the government hinders that economic growth, which is a private sector.
They do. I agree with your view. Yeah.
Yes. So the bureaucrats, I'm using the word bureaucrats rather loosely, the state bureaucrats and the federal government bureaucrats and the Federal Reserve's bureaucrats and all those bureaucrats, wherever the hell
Right.
these guys are.
Right.
So they are hampering the economic growth of the private sector and capitalist sector or corporate management sector.
Yeah, in my view, that your view is correct. I did a study.
Okay.
And I look back over the last 5-year period. I did this study about 2 years ago, before the pandemic meltdown.
Right.
I looked at the previous 5-year period of time, and I looked at the 50 largest economies in the country, or in the world. I'm sorry.
Right.
And I look at those 50 countries and asked over that 5-year period of time, what was the average real GDP growth rate?
Right.
What was the average top marginal tax rate? And what was government spending as a percent of GDP? And there was a very strong correlation behind countries that had high tax rates and high government spending rates, and they also had low GDP growth rates.
Yeah.
And irrespective of whether they were emerging economies or developed economies, it didn't matter. There was a strong correlation with that data, with those data streams. And so I don't know if high government spending leads to low growth or low growth leads to high government spending. I don't know which comes first, the chicken or the egg, but the two tend to go hand in hand. So your view, I think, is correct that high government spending accompanies slow overall economic growth rates. And that's not just here, that's globally.
Yeah. Well, this particular Biden administration has dumped so much laws and all the Inflation Reduction Act and this act and that act, and I have no idea. I mean, like people are saying that the economy is being suffocated, meaning with all those buy minerals from in the Inflation Reduction Act, buy minerals from here to get $7,500 this, and Tesla is doing it in Austin, and God knows everybody is doing in Zambia and all that stuff. So I don't know. I mean, I'm ranting now, but it doesn't make any sense, whatever this government has done it.
Well, it seems to me, and I wrote about this issue just this last few weeks. I produced economic pieces internally for our staff, and
okay,
that it seems to me that government spending, for most people like it. They may not like all of it, but they like their project, whatever their project is, be it defense spending or whatever issue they have in their minds.
Right.
And so as an American population in total, I'm like, one of the things I said was, we've met the enemy and he is us. And the American people in general like the government to spend money on their project, but maybe not the next guy's. Well, everybody's that way. So, we're kind of going through that phase of trying to figure out what we're expecting out of the government. And the government knows that. I mean, these politicians know that issue. So anyhow, that's kind of the way it goes.
You want to say that NIMBY, it's a behavior of a NIMBY, not in my backyard or something like that.
That's right. That's right.
Yeah. But see, this House Republicans are talking sense now. I mean, they'd like defense, I understand that, but they want to cut the spending of this federal government. And why was this Republicans not winning by larger majority?
Yeah, good question. Question.
I'm just curious as the next guy, just by 5 seats or 10 seats or whatever that number was in the midterm. And we didn't, I mean, I vote Republican over here in my district and all that. And that's about it.
Yeah.
But we never won meaning in the federal government. So something that the American people also don't understand, I guess. Anyway, I'm rambling now, but it's okay.
We're in a blue city.
Huh?
Awesome.
No, yeah, I know. I voted for Kirk
That is
Watson
red.
anyway. I understand that. No,
Yeah.
Kai, I know. I understand that.
So actually, it's other people have other financial questions for Bill. So sounds like your suggestion. We need to look at small cap this year.
And don't be frightened by the stock market. I think we're probably going to see some volatility going forward. We've indeed may get back well below 4,000 this year. I'm not sure, but I'm looking at it as an opportunity of placing high quality companies and small cap companies in my portfolio. Yeah.
What do you think about the crypto, the fiasco of crypto?
Well, we really don't make any comments on that. I don't follow crypto. I don't understand exactly what it's all about. So I just leave it alone.
All right.
Appreciate the time though, guys.
Yeah, thank you for your service.
One thing, Kai, if I could mention, and I just want to thank everyone on behalf of Mariner Wealth Advisors for letting us join, and Charles Schwab. We have William here with us as well. Wanted to let everyone know, Bill does a ton of financial pieces that you can find on our website at marinerwealthadvisors.com. So if you would be interested to see more of his work and his writings, you can go to our website. If you or you can ask Kai, he can get with William, and we can get some information together and make sure you have our website and our link just to see some of his different pieces.
Yeah, I forgot to introduce William is our local Charles Schwab. Actually, he's my manager, my money manager, and Grant is based in Dallas. Dallas of Fort Worth, in that area, right? And,
I'm in Dallas.
Okay, yeah. So Bill is in Ohio.
No, he used to be in Kansas City,
Kansas City,
and then
okay.
he got smart and moved to the sunny state of Arizona.
Oh, okay. Yeah.
But he's
Goldwater State, huh?
Yeah, he's still a Kansas City fan. I know that for sure.
Oh yeah.
Oh yeah. Go Chiefs. That's right.
Okay.
Gunsmoke is from Kansas City, isn't it?
Oh yeah. Well, it's Gunsmoke.
Yeah.
That's
Matt Dillon.
That's Dodge
and all
City.
that.
It's Dodge City.
Yeah,
Kansas
that's
City.
Dodge City.
Dodge City. Yeah.
I was born about 50 miles from Dodge City.
Okay.
Oh, is that right? Oh,
Yeah.
Okay.
Also home of good barbecue.
Yeah.
Yeah.
Thanks, everybody.
Yeah. Okay. All right.
Appreciate
Thank
the
you.
opportunity. Take care now.
Thanks, Bill.
Thank you.
Thank you for your conversation. Bye.